You have to take your emotions out of investing. You cannot be angry. You cannot be bitter. You cannot be mad. You can't get too high or too low when you're investing in stocks. But if you panic, you typically will make a bad emotional decision with your stocks, with your money, with your investments, right? So guys, this is how to invest and outperform 99% of all the other investors out there. I want to go over 7 quick things to help you be a better investor, better than most other people that are out there, right? You don't have to reinvent the wheel. You just got to do the fundamentals well. Now, the first fundamental thing as an investor that you need to do that'll help you be better than 99% of all the other investors is simply create an investment plan. You can do it on a spreadsheet. You can write it out on a piece of notebook paper. It doesn't matter, but you got to have a plan of action. Come up with your core values, your core beliefs about business, your risk tolerance level. And once you come up with those things and you write them down, then come up with a strategy, a plan of action. Most people, they're not investing with a plan of action. They're not investing from a strategy. They haven't thought this thing through. A lot of people, they see a good stock, they just go get it. Or they see a good report, a good article about it, they just go buy it. Don't buy stocks like that. Fundamental thing number 1 is to come up with a specific strategy. How are you going to buy stocks? What are you going to be looking at? What is your list of criteria that's going to make you want to buy a stock? Whether it's the technical stuff or the non-technical, right? The quantitative analysis or the qualitative analysis. Either way, both of them, put them in a mix, figure out what works for you, and you have your own strategy by which you buy stocks with. Not just an article on CNBC or an article on CNN or wherever you get your news from, but a specific core beliefs, vision, goals, and your strategy. Whatever that strategy looks like. Maybe you want to create some type of a checklist that you go through and you check off each of these things that helps you determine whether or not you're going to buy a stock or not. That's the first thing. Most people don't do that. Most of us retail investors just don't do that. So do that. You'll be ahead of most people. The second way to invest and outperform 99% of all the other investors is to commit to consistency over time. Investing is a long game. In the short run, you're going to have some losses. You're going to have some big losses here and there. But over the long haul, you're going to be better off if you plan to invest for the long term. So the key to investing for the long term is being consistent over a long stretch of time. Maybe dollar cost averaging into a stock or stocks for a long time. When I say long time, I'm talking 5, 10, 15, 20, 30 years, right? There should be stocks in your portfolio that you have today that you should have in 15 years because they are staples of your investment portfolio. But you have to be consistent. And one way to be consistent is just dollar cost average. Put a set amount in at specific intervals, maybe every time you get paid from your job or twice a month or once a week, and be consistent with it. Don't stop it. That's why when you do it, you ought to just automate it because it makes it easier for you. Now, that's the second thing. Now, the third thing is simply invest in what you understand. If you don't understand tech, don't invest in the tech sector, right? Start with what you know. What is the area you know? Is it food? Is it construction? Is it energy or utilities, right? What do you know? What do you have experience over your course of 5 or 10 or 20 or 30 years, right? Or 40 years? What sector do you know and you understand? Maybe you were in banking for a long time. You understand financial lending and the financial services, right? You understand banks, or maybe you understand Visa and MasterCard, right? Whatever the sector is that you understand, that's where you should start your investing. Now, it doesn't mean you only do that. You could learn another sector as well. But the point is if you don't know it and you don't understand it and you can't understand how they make their money or how that company makes money, don't invest in it. Move on to something that you understand better. Really, it boils down to the basics, the fundamentals, right? So if you want to be good at anything and everything, you got to do the fundamentals right. I mean, think about basketball, baseball, basketball in particular. The most fundamental people who can do all the fundamental things well, shoot, rebound, pass, dribble. If you can do the fundamentals better than everybody else, you've got a leg up, right? You're going to be better than everybody else just by doing the basics. So in terms of investing your money, investing in the stock market, be basic. Guys, if you're getting anything out of this video, do me a favor and smash that like button below. Also, please share this video with your friends, your family, and your network of people. And don't forget to drop that comment below. I want to hear from you. Now, let's get back to the video. Now, the fourth way to invest and outperform most people is simply to make sure that you risk what you can afford to lose. If you can't afford to lose it, don't play with the money. So what you do is you create the budget. You understand how much money you can actually spend on investments, or how much extra cushion of money you have left every month after you pay your bills that you can spend on investing, and you spend that money, right? You don't want to spend the money that you have to pay for your rent or your mortgage, or you have to pay for some of the need like food, right? You want to make sure you have money that you can afford to lose if you decide to take the risk that's associated with the market, because there's always risk. Right? Anytime there's money involved, you're dealing with risk. It could be a little risk, could be a lot of risk based on how old you are, how much you want to risk. But that's why I said at the beginning, you got to know your risk tolerance and then take those risks, but only risk the amount of money that you can actually afford to lose. That way you don't have to put your money in the stock market and one day have to go borrow it or take it out because you have an emergency. Have an emergency fund already set to the side before you jump into investing. That way, if something goes wrong, you don't have to touch your investments. They can continue to compound and grow. And then you can also take care of your emergency at the same time. But always risk the money that you can afford to lose. Very important. Now, number 5 is the big one that most people know. Diversify your investments. Please, please, please do not have all of your money sitting in 1 or 2 stocks only. If you want to have an ETF where all of your money is going into a mutual fund or ETF or index fund, that's okay, because the nature of what an ETF or an index fund is a bucket of a whole bunch of stocks. So you're diversified if you have, let's say, the S&P 500 ETF. Right? If you have that ETF, you already have 500 companies in that bucket, so you're fairly well diversified. But if you only have one stock, one company, or only 2 companies, all of your money is in that 1 or 2 companies, you've set yourself up for some serious problems if something goes wrong with those companies. So you want to spread it out, be diversified, and make sure you're not putting all your eggs in just one basket. Now, the 6th one is one that I like to do. Everybody doesn't like it, but I think it's pretty important, is reinvesting your dividends, right? You can always invest in companies that pay shareholders dividends, right? A piece of the profits. A company makes a lot of profit. They share that profit with the shareholders. And guess what? You see a dividend check, right? I always say, look, it's okay to invest in those type of companies, but I always like to reinvest those dividends because I want to see those dividends be affected by compound interest, just like I want to see the rest of the investment get a hold of some compound interest. When you reinvest dividends, your compound interest grows exponentially because you're throwing all the money that the company threw out to you right back at the stock. And so you're putting more and more money back into it. And over the course of 20 or 30 years, that can be the difference between $700,000 in your portfolio or $1.2 million in your portfolio. It really can make a huge difference in a lot of ways, depending on how long you've held a stock and how much those dividends actually were. And also about dividends, let me say this. Be careful with companies that have high yield dividends, because sometimes those high yield dividends means they're trying to attract new investors. And keep in mind that every dollar that you see that comes back to you in terms of a dividend as a shareholder, that's money that the company did not put back into growing the company and put back into making the company a little more liquid, making the company lower its debt, right? They gave that money to shareholders instead. Sometimes for some companies, you got to be careful about a high yield on that dividend, because that means that they're giving a lot of money back to shareholders, but they're not necessarily growing the company like they could be or should be with that money. So keep that in mind as well. But always, in my opinion, go ahead and reinvest those dividends so you can watch those dividends compound as well over the course of a long time. Now, finally, number 7, super important. Please, please, please. Again, another please, please, please. Do not panic. You don't have to panic. When you see markets go down, when you see stocks go down, you see your favorite stock that you enjoy, you like, you've had it, and you see it dip and go down, do not panic. The whole idea of the stock market is to buy low and sell high, or buy low and hold forever or a long time. But when you start panicking and going with that human nature to get fearful, hey, you're going to lose a lot of money ultimately, because you have to take your emotions out of investing in order to be as rational as possible. You cannot be angry. You cannot be bitter. You cannot be mad. You can't get too high or too low when you're investing in stocks. You have to be sort of even keel, because even keel is going to make the best rational decisions based on all the other things I talked about in this video. But if you panic, you typically will make a bad emotional decision with your stocks, with your money, with your investments, right? So do your best to sort of go against that human nature that causes you to panic when the stock market goes down. Look at the stock market going down as more opportunity to continue to dollar cost average and buy shares of the stock or the company at a discount, right? Look at that as an opportunity as opposed to a reason to react emotionally and panic. Guys, this is how you want to invest so you can beat and outperform 99% of all the other investors that are out there. Really, it boils down to the basics, the fundamentals, right? So if you want to be good at anything and everything, you got to do the fundamentals right. Do the fundamentals better than everybody else can and everybody else will, because everybody else is working on emotion. You're just doing the basics, and that'll help you become better than 99% of all investors. Hey guys, I hope I was able to give you something of value on this quick video. If you got any value, do me a favor, smash that like button and share the link to this video with somebody you know, somebody that you think wants to start or learn a little bit more about investing in stocks. Just share the link with them and drop me a comment below, guys. I want to hear from you. Are there any more fundamentals that you can do as an investor that will put you light years ahead of everyone else? Let me know in the comments below. The best person who's going to take care of the old you is the young you. Do me a favor, take care of yourself and take care of other people. Until the next video, peace.